Sam Bankman-Fried didn't like Bitcoin. Why didn't he like it? Completely decentralized, transparent. He couldn't control it. FTX and Celsius and 3AC, completely opaque and centralized. Those were the companies that went under. The blockchains, whether you're talking about Bitcoin or Ethereum and many others, they didn't skip a beat. Transactions did not stop. And I think that has given us a lot of confidence that actually they're on the right track. We think there are 3 revolutions taking place simultaneously. There's the money revolution, which is mostly Bitcoin, a bit Ether. There is the financial services revolution, which is Ethereum, as is this notion of digital property rights. First time. That's Web3. Digital property rights. With an economics background, I know that the best way to lift people and countries out of poverty is to give them immutable property rights.
Hey guys, welcome back to Library of Wealth. Today we have the CEO of ARK Invest, Cathie Wood, sharing her insights on the recent market conditions and how Bitcoin will play a major role in the coming months. The world of crypto has seen its fair share of ups and downs over the years, and in a recent interview with CNBC, Cathie Wood shares her thoughts on the current state of the stock and crypto market and highlights the resilience demonstrated by decentralized and transparent systems like Bitcoin. She views Bitcoin as a rules-based digital monetary system with a capped supply and believes it to be an insurance policy against the confiscation of wealth in scenarios of hyperinflation and fiscal crises brought on by recent global events. In the larger economic backdrop, she discusses the impact of the Federal Reserve's monetary policy on the market and reflects on the recent inflation and interest rate scare that hit long-duration assets hard in 2022. Let's get right into the latest interview with Cathie Wood as she gives her prediction for crypto, the Fed's impact on the stock market, and what we can expect in 2023. Don't forget to hit the like button and subscribe to the channel if you enjoy the content we do here. Let's get right into the video.
The Fed really wants to make sure that it has done its job, and job owning is part of it. But I do believe the equity market, certainly the way we've started the year, are beginning to see to the other side. And sure, maybe they go up another 25 basis points, maybe 50, I don't know. But I think we're just about there. And the market is a discounting mechanism after all. So if it can see to the other side, then we should be okay. Early in my career, in the early 80s, it was the same thing. But those who bet on lower inflation and interest rates long-term were the winners. And it's always the data are very volatile, especially when you have the warmest winter in history here in the Northeast. So I think that's distorted the numbers quite significantly. And the interesting thing about seasonal factors, if that is the distortion, they all have to work out to 1 over the full year. So if they bumped the numbers disproportionately in January, it'll come out of other months.
I don't know. February's a little warm too. Yeah. Some people look at your ARK Innovation Fund, Cathie, as a barometer for what the Fed is doing, right? And they say it's back on the rise. Speculative behavior is back. Unprofitable tech companies are getting bid again. The Fed has more work to do.
You know, it's very interesting that people do link the two together. I think that the muscle memory has more to do with the tech and telecom bubble and bust and people fearing that we may be in the same situation. We are not. In fact, the seeds for everything that's happening today, all of the innovation that's happening today, they were planted in the 20 years that ended in the tech and telecom bubble. But the technologies back then were not ready. The costs were way too high. We didn't get the big breakthroughs in artificial intelligence until deep learning 2012, transformer technology 2017, and now finally we have a chat GPT. People are beginning to understand that the ground is shifting underneath us when it comes to innovation. Unlike in the late 90s, investors rushed into the late 90s, weren't ready for them. Now they're running away. They really are running for the hills. And what are the hills? They're benchmarks. That's where they think safety is. But if we're right, the benchmarks, which represent the traditional world order, are going to be disintermediated, disrupted by the most massive innovation period in history. we've been criticized for owning too much, actually, and it has been our largest position for the most part for years. So our conviction remains very high. One of the reasons we do sell as it moves above 10% in the various strategies is that gives us the psychological wherewithal after we've taken profits to buy when it is falling to 100, which it did not too long ago. So that's part of our trading around opportunities that volatility gives us.
How are you thinking about competition that's come online in the last 12 months?
Yeah, we're very interested in the news coming out of this March 1st day. And we think it will be about robo-taxis effectively. Elon has said that he believes that he'll be able to cut the price of a car in half. We think that a robo-taxi could start at $25,000, and if you've got tax credits, that to take you into the high teens. It's going to be very difficult for the competition to beat that. In fact, they won't be able to come anywhere near it given their current battery technology. And
so not just the dealer network, not just their marketing costs,
no,
just the battery.
The battery is critical, and Elon's riding down the consumer electronics battery curve. Other automakers chose a different curve that was higher cost to begin with. So they're riding down a curve, but Elon, because he's innovating in battery technology, and we'll hear more about that as well, is, we believe, 3 to 4 years ahead of the competition, which means for the same power and range, another company, if they wanted to price at the same level as Tesla, will have to lose money, especially if he cuts prices in half.
If they're so ahead of competition, why does he have to cut prices?
This is the beauty of innovation. He's following a learning curve. There's the drive train is following a learning curve. And for every cumulative doubling in the number of vehicles produced globally, costs decline 28%. So he's passing them along. As you'll notice, as prices have come down, his margins have gone up. He's enjoying economies of scale. And we do believe that margins for Tesla are going to become explosive with autonomous mobility. Most of our companies are going to be sleepers because of that proprietary data. ChatGPT, if you've been reading about it, is really scraping the internet from all its history for information.
So far this year, Cathie believes that inflation will eventually come down to the 2% target level set by the Federal Reserve, and predicts that inflation could fall below and even enter into negative territory due to the ongoing contraction in the money supply. With technological innovations such as cryptocurrency and blockchain technologies being deflationary, she believes this will in turn cause a boom in the products and services and a shock to the market. After getting battered by 2022's bear market, the tech-heavy Nasdaq in particular had its best showing in January since 2001. This is an indicator that technology and innovation is on the rise, and we could see a massive surge this year. What do you think about Cathie Wood's prediction for crypto, the stock market, and what's to come in 2023? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.